We are tackling what might seem like a nearly impossible challenge today. We're taking the extremely complex, high-stakes world of corporate financial reports.
And they are complex.
Specifically, the annual reports and financial statements for Zedur HE, right through the third quarter of 2025. And we're going to turn them into crystal clear, actionable, and frankly surprising insights for you, the individual retail investor.
Right.
This dive isn't just about parsing numbers. This is about finding those crucial signals hidden deep in the operational noise.
And, the unique complexity of the Turkish financial environment, especially when you have to factor in hyperinflation and just intense currency volatility.
Exactly.
Welcome.
Welcome.
Our mission in this deep dive is pretty explicit. We want to be your expert guides through these sources. Zedur HE is a company that's going through a really profound strategic transformation.
A huge one.
A huge one. They're pivoting completely out of tourism and doubling down, and I mean aggressively, on energy and construction, specifically renewables.
So we have to look past those surface-level net profit figures, which, as you said, are highly distorted.
We have to. We need to systematically demystify the two biggest non-operational factors at play here.
Okay, so what are those two financial leviathans we have to wrestle with today?
Okay, so first, it's the inescapable impact of Turkish inflation accounting, the infamous TMS 29.
Wow.
It essentially rewrites the company's profit story because of their high debt exposure.
Right.
And second, we have to dissect the sophistication of their currency risk management, specifically their TFRS 9 cash flow hedging strategy.
Oh.
Ultimately, we need to evaluate if their aggressive growth strategy in Depolama Lagunas Energisi Centrale, or DGES, is actually financially sustainable.
Especially given their currently weak operational performance and, like you said, that immense debt structure.
Exactly. We're cutting through the jargon so you can understand not just what happened, but why it matters to your investment thesis, right now.
I appreciate that focus. That context sets the stage perfectly. Okay, let's unpack this. Let's first get to know the company a little. Before we dissect any financials, we really need that foundational context. Who exactly is Zedur Energy Electric Euratom A? And, what do they actually do today?
Well, Zedur has a really fascinating history of evolution, which is absolutely central to understanding its current risk profile and its strategy.
Right.
The company's roots go all the way back to 1990, but it was under a very different name.
Utopia Tourism.
Utopia Tourism, so tourism.
Exactly. For decades, they were heavily invested in the high-stakes tourism sector, most notably operating the huge Utopia World Hotel.
And they pivoted away from that business entirely. That right there, that's the single most important strategic signal we have to highlight. That's a massive decision for a legacy company.
It is a decisive move, absolutely. The report confirms that in March 2021, they completed the transfer and exit from the tourism and hotel management business.
And this wasn't just a whim. This was forced on them. It was. This strategic shift was forced by adverse and really overwhelming macroeconomic factors that were prevalent in that sector. Think about the severe pressures of that period.
You had rapidly rising foreign exchange rates.
Right, which ballooned all their imported costs. Then you had the shock of global crises like the Russia-Ukraine conflict, and of course the crippling, lingering impact of the COVID-19 pandemic on global travel revenues.
So a perfect storm.
A perfect storm. These factors just severely reduced their tourism income while at the same time dramatically increasing their operational expenditure. The business just became unsustainable.
So they made a hard pivot. And that pivot lands them squarely in two core areas today: electric energy production and sales, and construction contracting, which is often known as EPC, engineering, procurement, and construction.
Right.
So let's break down their current operational footprint in energy first.
Okay. On the energy side, they operate through their subsidiary, which is 99% owned, Isparta Electric Euratom A.
And what's in their portfolio?
Their existing portfolio is, I'd say, modest but stable. It includes the Chukrishaya Hydroelectric Power Plant, that's a HES, located in Isparta, that contributes about 4 megawatts of capacity.
Okay, so a hydroelectric plant. What else?
Additionally, they have acquired and now manage solar power plants, GES, which are spread across Muğla and Denizli. And all that brings their current total installed capacity up to 16.2 milliwatt-h.
That's a decent baseline of renewable assets.
Oh, yeah.
Where does all that electricity go?
It's sold through EPS.
Which is the energy market's operating e-shack.
Exactly. It's generally sold at day-ahead market, or PTF, prices. And we'll talk later about how they mitigate the risk of that market volatility. There's a mechanism called Yiki Dem.
Right. Okay, we'll get to that.
Yeah.
Now, for the other half of the business, construction. It seems like they have deep roots here, going all the way back to the company's founding in 1990.
Oh, absolutely. Their expertise in construction is long-standing and highly specialized. They don't just build, housing. They focus on complex infrastructure projects. We are talking deep tunneling, extensive sewage systems, and other high barrier to entry infrastructure.
So the really tough stuff.
The really tough stuff. Alongside that, they do various building types like luxury hotels, factories, and housing. Their focus is on high-quality execution and meeting rigorous standards.
And they have the certifications to prove it, I see.
They do. It's evidenced by holding internationally recognized certifications like ISO 9001, ISO 14001, and OHSS 1801.
So what's the scale of their history in construction? I mean, what kind of value are we talking about?
To date, the value of their completed project stands at approximately 6 billion Turkish lira.
6 billion. That's a significant history.
It is. So while the growth story is clearly in the energy sector now, with that DGES pipeline, the construction division provides a proven, long-standing, and sophisticated foundation of revenue and cash flow.
And that's often crucial for securing project financing for those new energy projects.
It's absolutely crucial.
Let's talk about the structure, location, and personnel. Where is this operation physically run from?
The company was registered way back in 1990, and their headquarters, along with all the centralized operational management, are located in the capital, Ankara, specifically at Çankayama, 285. So the physical footprint is very centralized.
And the size of the workforce is, I have to say, surprisingly lean for a company managing 6 billion TL worth of project history and a growing energy portfolio.
That's a great observation. It really is. The group's average total personnel count, which includes all employees of the parent company, subsidiaries, and even contracted workers, stands at just 40 people as of September 30, 2025.
40 people.
Just 40. It's an extremely small core team.
Wait, a company that manages massive infrastructure projects, tunnels, factories, and a multi-megawatt energy pipeline has only 40 employees. I mean, does that concentration of expertise create a single point of failure risk? Or does it just suggest they heavily outsource the core execution to subcontractors?
It absolutely implies heavy reliance on subcontracting for the physical execution, especially in construction. You're spot on.
So those 40 people are the brains of the operation.
Exactly. The 40 personnel are likely the highly specialized core engineering team, the finance team, legal, and the executive team. And while a lean structure can mean agility and lower fixed administrative costs, you are right. It concentrates intellectual capital, and it definitely increases dependence on the external contracting environment.
Which adds a layer of operational risk for these complex, timeline-sensitive projects.
For sure.
Speaking of structure, let's look at their subsidiaries, which seem to clearly map out their future strategy in renewables.
They do. It's like a roadmap. While Isparta Electric Üretim A, the 99% owned one, manages the existing HES and GES assets. The strategic future lies with these battery systems and renewable energy investment companies.
Okay, so who are they?
We have Diğer Batarya Sistemleri ve Yenilenebilir Enerji Yatırımları Eş, which is 94.5% owned, and indirectly, Çınar Batarya Sistemleri ve Yenilenebilir Enerji Yatırımları Eş.
And that one's owned by Isparta Electric.
Right, 75% owned by them. The names themselves are the giveaway, production, and critically energy storage.
The battery systems.
The battery systems, the DGES projects, that is the sole focus of these new vehicles. This is where all the aggressive growth is planned.
That brings us to capital structure and shareholder governance, which, for you, the retail investor, is where you determine if the company is run for you or for the insiders. Let's lay out the capital figures first.
Okay. The company operates under a registered capital ceiling of 1.25 billion TL. Their current issued and paid-in capital is 174.75 million TL.
And it's really important to remember something about that number, isn't it?
It is vital to remember that this current paid-in capital reflects a massive 599% bonus issue and capital increase that was finalized in May 2024.
So a huge dilution event.
A huge one. This action significantly increased the share count, which will naturally dilute the earnings per share calculation. That's something we'll definitely need to analyze later.
Now, the shareholding breakdown. This reveals a highly concentrated control structure.
That's the key governance risk right there.
Yeah.
The controlling interest belongs primarily to Zekai Dorsun, who has 52%, and Necat Rakaydir Usun, who has 8%.
So together, the Dusun family has 60% direct ownership.
Exactly. The publicly held portion, the Halka Asak, is 40%. But the economic ownership only tells half the story.
Okay.
The other half is the critical nugget for retail investors. This 60% ownership is buttressed by privileged A group shares.
Okay, unpack that voting rights disparity because this is where the minority shareholders' influence just
It
evaporates.
really does. The A group shares, which are held exclusively by the Durson family, carry 5 voting rights per share.
5. And the public shares.
The B group shares, which make up the public float, carry only 1 voting right per share.
So a 5-to-1 disparity.
A 5-to-1 disparity. This means that the family retains ironclad, near total control, not just over general resolutions, but explicitly over the board of directors. For example, if the board has 5 members, the A group shareholders elect 4 of them. If it expands to 7 members, they elect 5.
That's staggering. So even though the public owns 40% of the economic equity, they have a fractional share of the voting power that is, I mean, it's functionally meaningless in terms of challenging management or major strategic decisions.
That's a fair assessment.
It fundamentally implies that minority retail investors are placing almost absolute trust in the good faith, the strategic acumen, and the governance of the controlling family.
That is the implication, yes. It completely shifts the investment evaluation from, can I influence the company, to do I trust the individuals running it?
And on the board itself.
There are 5 members. And it's worth noting the 40% female board representation. You have Zeynep Dursun and Burfin Avicii Bolton, who is an independent member.
So 40% is a positive signal.
It provides a positive signal regarding diversity in corporate governance standards, for sure, even if that structural voting power is concentrated.
Final governance check. Executive compensation. Was there any hint of management enriching themselves via massive bonuses or stock options during this turbulent period?
No, and this is a significant positive disclosure. The executive compensation structure is strictly fixed.
Okay.
Management and board members receive only fixed monthly attendance fees set by the General Assembly. The report explicitly states that no performance-based bonuses, no premiums, no stock options were paid during the period.
And no loans to management.
None. The company did not extend any personal loans or guarantees to management or board members. This indicates a very clean governance practice regarding executive financials, which is highly reassuring given the concentration of control we just talked about.
That's excellent insight into the company's roots, its lean structure, and the power dynamic. Now that you know who Zedur is and how they are structured, take a quick moment to hit that like button, subscribe to the channel if you find this analysis helpful, and share this deep dive with anyone else who needs help turning complex financial data into market intelligence. We appreciate your support as we move into the strategic analysis. Moving on to part 2, let's talk strategy and the competitive landscape. Zedur has chosen a demanding path, energy, and construction, but how does that strategy play out in the context of the Turkish market, especially when the macroeconomic winds are so fierce?
Well, the company is operating in sectors that are deeply intertwined with national macroeconomic priorities.
So their fate is tied to government policy.
Exactly. It's closely tied to government policy and infrastructure spending. In the energy sector, Zedur is banking on 2 core drivers. First, the increasing global and national need for reliable energy sources. That's a given. And second, the long-term structural attractiveness of renewable energy. This is strongly supported by technological development and the national goal of achieving energy independence.
Right. Turkey views energy independence as a major strategic goal, and renewables, like their HES and GES assets, are the pathway to that. But that market is volatile. Earlier, you mentioned they have a key defense mechanism.
They do, and this is a critical strength, revenue protection through what's called the YEKDEM scope.
YEKDEM.
Right. So while the company sells electricity via EPA at those volatile day-ahead market prices, the power generated from assets under the YEKDEM framework.
The Renewable Energy Support Mechanism.
Yes, that framework comes with a government purchase guarantee that is priced in US dollars.
Okay, let me put a finer point on that for you listening. In an environment where the Turkish lira is depreciating constantly, a USD-linked revenue stream is essentially a built-in hedge for a portion of their top line.
It is.
That significantly shields them from the TL pricing risk that plagues purely domestic generators.
Precisely. It provides a degree of pricing stability and predictability that is highly coveted in that market. It helps anchor their revenue, even if their input costs are soaring. This mechanism is really one of the few financial buffers they have on the income statement side.
What about their competitive edge in construction? Is it just about securing tunnels?
In construction, their edge is their established reputation, their specialization, and their certifications. They aren't trying to compete on every single building project.
They have a niche.
They have a niche. They specialize in complex, challenging infrastructure work tunnels, sophisticated sewage systems, specialized industrial facilities. The ability to consistently meet demanding deadlines and quality standards, which is evidenced by their 35 years of operation and their many certifications, allows them to command higher margins and access projects where the competition is limited because of the required technical complexity.
So it's a long-term, high-barrier to entry business that provides stability.
That's it.
Now let's synthesize that strategic view into a targeted SWOT analysis. Let's start with the strengths, the S, recapping what we just discussed.
Okay, the strengths are foundational. First, you have that established position. Decades of operation in the high-barrier construction sector since 1990. That provides resilience and a strong reputation.
Okay, 1. What's 2?
2 would be a revenue protection. That USD-linked revenue component under YICDEM protects a portion of their energy sales from the extreme domestic pricing and currency volatility.
And 3rd?
Third, and this is a big one, balance sheet strength. Their financial foundation is structurally secure. It's evidenced by a very healthy equity to total assets ratio of 0.75.
So 3/4 of the assets are funded by permanent equity, not debt.
Exactly, and that minimizes their long-term solvency risk.
Okay, now moving to the weaknesses, the W. This is where the aggressive macro environment and their historical decisions create some significant pressure.
The primary weakness is an acute vulnerability to foreign exchange risk, FX risk.
Even with the YICDEM revenue.
Even with that partial USD revenue stream, because the company holds a massive amount of USD-denominated debt. Recent excessive depreciation of the TL has translated inevitably into high currency translation loss risks on their bank liabilities.
And there's an operational weakness too, right?
A big one. We have to stress the operational deterioration. There was a significant drop in gross profit and a definitive shift to an operating loss in the first 9 months of 2025. And that's before any inflation adjustments.
So their core business execution is currently inefficient and losing money.
At its core, yes.
Okay, let's focus on the opportunities, the O.
Sure.
This is Zedur's major growth story, and frankly, the reason investors are holding the stocks.
Yeah.
These DGES projects.
This is the massive carrot. The biggest opportunity lies in their aggressive renewable expansion, particularly the Dipolomala Gunet Energisi Centrali projects, which crucially integrate battery storage.
And the most advanced one has a key approval, right?
It does. The most advanced project is the UNAC DGES in Konya, and it has secured CE approval, the environmental impact assessment. That is a major milestone.
What are the specifics of this project, and why is that storage capacity so important?
The UNAC project is slated for 22 mLOBM 15 MOE with 15 milliwatt-hours of dedicated storage. The key differentiator is the storage.
So it's not just about when the sun is shining.
Exactly. Storage means the energy can be dispatched when the market needs it, most often during peak evening hours. This drastically increases the value and reliability of the power they generate.
So what does that mean for their overall capacity?
The company projects that this single project will increase their current electricity generation capacity by a massive 135% to 38.2 milliwatt-hours.
135%.
That is not incremental growth. That is a
Yeah.
transformational leap that, if they execute it, redefines the entire company.
And they have a pipeline beyond that.
They do. They have a pending pre-license application for Shinar Battaria's DGES project as well.
So the vision is clear. Become a critical, large-scale player in renewable energy with high-value storage capacity. But what about the threats, the T? What are the risks that could derail this whole strategy?
The threats are almost entirely financial. They stem from the continued instability of the Turkish economy.
So macro risks.
All macro. They are exposed to high interest rate risk, which makes servicing their existing debt expensive. And then there's the ongoing volatility of high inflation and fluctuating exchange rates, which directly impact the cost and the size of their debt load.
And that USD debt is the big one.
The sheer scale of their USD debt makes them extremely vulnerable to currency movements. Financial risk is currently the primary threat to their impressive strategic opportunity.
Here's where it gets really interesting. Now we can move on to our analysis of the financial statements, which means we have to navigate the inflation accounting that fundamentally changes how we read these reports.
Yes,
Before we look at a single number, let's remind ourselves of the distortion field we are operating in.
That's an excellent starting point. These numbers are all presented under the TMS 29 standard, the Turkish Accounting Standard 29, which mandates adjusting financial statements to the purchasing power of the Turkish lira as of September 30, 2025.
So everything is inflation adjusted.
Everything. This is essential context because when we compare 9M 2025 to 9M 2024, we are comparing two sets of inflation-adjusted figures, not the raw nominal numbers. This adjustment significantly complicates comparison, but it is necessary to understand real profitability.
Okay, so let's start with the operational top-line revenue, or hasılat, for the first 9 months. The first shock here is the massive decrease.
Indeed. Revenues dropped significantly, falling from 151.4 million TL in 9M 2024 to 102.6 million TL in 9M 2025.
Wow.
That's a decline of approximately 32.2%. This is the primary operational red flag of the report. A decline of this magnitude signals one of two things, or, a combination.
What are they?
Either the construction segment failed to secure or complete major contracts during the period, or the realized energy prices after inflation adjustment were significantly lower. Or maybe both.
And it's just they struggled to maintain the real value of their sales.
That's what it points to.
Okay, so that sets up a devastating situation for profitability, especially in a high inflation environment where costs typically rise faster than non-index revenues. How did the gross profit fare?
Gross profit plummeted catastrophically by 67.5%.
67%.
It fell from 44.1 million TL to just 14.4 million TL. This sharp collapse reveals that the cost of sales did not decrease in line with the revenue drop. In fact, their costs became proportionally much, much higher.
So the margins got squeezed.
They got squeezed incredibly hard. This heavy compression of the gross profit margin strongly suggests rising input costs, potentially fixed costs like high amortization, which stayed sticky at 47.1 million, and most crucially, a fundamental lack of pricing power in their markets to effectively pass inflation on to customers.
This suggests a failure of contract locking in the construction segment, or maybe the fixed operating costs of the energy plants have just become disproportionately high compared to the revenue they are generating.
That is the most logical conclusion. If you're operating in a fixed-price contract environment, but your labor, materials, and maintenance costs are inflating daily, a 67.5% drop in gross profit is the inevitable, brutal outcome.
And the ultimate result on core operations, the operating profit, or İsas Faaliyet Kara.
Operationally, the situation is alarming. The company swung sharply from a positive operating profit of 13.4 million TL in 9M 2024 to an operating loss of 6.1 million TL in 9M 2025.
An operating loss.
A negative 6.1 million. This negative figure is the truest reflection of their operational efficiency before financing or accounting effects. Zedur's core business activities, selling energy and building complex structures, are not currently generating enough income to cover their general administrative expenses and other essential costs.
They're losing money on the fundamental business model right now.
Yes, they are.
That is the headline result. Operational loss. So if they're operationally losing money, how in the world did the company manage to report a massive profit before tax? This is the moment we have to tackle the complexity of TMS 29. Let's talk about the net monetary gain.
This is the most critical and complex part of the entire report, yet it determines the final reported profit. Due to the high inflation in the Turkish economy, the required application of TMS 29 creates an accounting phenomenon, the net parasitic gain, or net parasal kazanç.
And that number was huge.
It soared to 218.3 million TL in 9M 2025, up significantly from 73.7 million TL the year before.
Okay, let me try an analogy here for the listener, because this is the section where most retail investors just throw their hands up. Before we look at that gargantuan number, can you break down the concept of being a net monetary debtor and why it generates this gain?
Absolutely. Zedur is a net monetary debtor because its total monetary liabilities, mainly its large bank debts denominated in USD and TLFAR, exceed its monetary assets, like cash and receivables.
So they owe more than they have in cash-like assets.
Much more. During hyperinflation, the value of those fixed debts shrinks dramatically in real terms, in terms of purchasing power. The accounting standard forces the company to recognize that erosion of the real value of its debt as a non-cash gain on the income statement.
So it's essentially an accounting reward for holding debt during an inflationary collapse of the currency.
That's a perfect way to put it.
So we have an operational loss of 6.1 million TL, which is the reality of selling energy and construction services. But then this massive Non-cash, purely accounting gain of 218.3 million TL comes in, generated by the macro environment and their debt position.
That's the central conflict. That colossal monetary gain completely flips the financial result. Despite the core operating loss, that 218.3 million TL adjustment resulted in a profit before tax of 147.7 million TL.
Which is up dramatically from the prior period.
Right, up from 35.4 million. However, we have to stress the quality of these earnings. They are non-operational, non-cash, and fundamentally driven by government-mandated accounting rules for a hyperinflationary environment, not by successful project execution.
That is such a perfect picture of the Turkish market right now. You can be running a fundamentally loss-making business, and yet the accounting rules, because you took on debt, reward you with a non-cash profit. Let's reflect on that absurdity for a moment. What does that incentivize management to do?
It creates a dangerous incentive
Yeah.
to prioritize financial engineering through debt management over genuine operational efficiency.
Right.
If management knows that an operational loss will be covered by the accounting function of inflation, the urgency to fix the underlying weakness in the gross profit margin diminishes. This is why you, as an investor, must mentally separate the 6.1 million TL operational loss from the 147.7 million TL pre-tax profit.
But even after all that, the operational loss saved by the inflation gain, the final net profit attributable to the parent company still dropped by 62.7% and went from 129.9 million TL down to 48.5 million. Why the sudden plunge after that huge pre-tax gain?
The primary culprit is the deferred tax expense. Despite the massive pre-tax profit, the company booked a massive deferred tax expense of 99.3 million TL.
99 million.
Yes, and that acts as a huge and necessary drag on the final result. While the exact mechanics of Turkish deferred taxation under TMS 29 are complex, this high expense just drastically eroded the benefit of that non-cash monetary gain.
And what does this translate to for the individual shareholder in terms of earnings per share, or EPS?
Well, the EPS declined significantly, from 0.74 TL down to 0.28 TL.
A big drop.
A very big drop. And this reflects the lower net final profit figure, combined with the impact of the increased number of shares outstanding following that 599% capital increase back in 2024.
The EPS is weak.
Very weak. It signals that even with the assistance of inflation accounting, the operational challenges and high costs are eroding shareholder value per share compared to the prior year.
So the income statement tells a dramatic story. Operationally struggling, saved by complex accounting rules, yet still reporting a major drop in net income. Let's look at the balance sheet, the core financial position.
Okay. Overall, the inflation-adjusted total assets remain remarkably stable. They were nearly flat at 2,736.9 million TL compared to year-end 2024.
So the overall scale of their capacity hasn't changed much.
Not fundamentally, no. This stability suggests the overall scale of their property, plant, and equipment, their energy and construction capacity, has held its value in real terms.
But we see a dramatic and potentially troubling shift within current assets.
Yes, total current assets more than doubled. They increased by 103.4%, jumping from 42.9 million TL to 87.4 million.
Where did that jump come from?
This sudden liquidity surge wasn't due to inventory buildup. It was concentrated in liquid items. Cash and cash equivalents surged by 119.5%. But the most striking change is the surge in trade receivables.
Which is money owed to them.
Exactly, and that jumped by 153.1%. From 19.1 million TL to 48.6 million.
A 153% jump in money owed to the company in 9 months. That is a huge red flag for the retail investor. It suggests sales are being made, but the cash collection period is stretching out rapidly. What are the specific implications of this?
When receivables jump that steeply, that's capital being sucked out of the operating cycle and just trapped on the balance sheet. For you, the investor, this increases the risk profile significantly in 3 ways.
Okay, what are they?
First, it directly contributes to the poor net operating cash flow, which we'll discuss. Second, it raises the potential risk of bad debt write-offs if one major construction client defaults. And third, it means Zedur is effectively financing its customers, tying up valuable cash that could be used for DGES investments or debt servicing.
And we don't know if these are slow payments from the energy market or construction clients.
The report doesn't specify, but either way, it's a massive drag on liquidity.
Let's move to the funding side, shareholders' equity.
Right.
How is that foundational stability holding up?
Total equity saw a marginal increase of just 0.54%, reaching 2,205.3 million TL pala. As we noted earlier, the key solvency ratio is extremely strong.
The 75% equity to assets.
Yeah. Exactly. Equity still constitutes a very healthy 75% of total assets. While it's slightly down from 76% at year-end 2024, this strong equity backing is the company's biggest financial defense mechanism. It reduces its long-term solvency risks substantially. They have a massive buffer.
And where did that slight equity increase come from?
It's complex. It's a result of inflation accounting. It includes the net period profit of 48.5 million TL alongside the absorption of past year's profits. And all these pervasive adjustments required by TMS 29 on non-monetary items like property, plant, and equipment, which get parked directly in equity to maintain the real value of the assets.
Okay, now let's talk debt. It's the source of that massive TMS 29 gain, but simultaneously the biggest source of financial risk.
That's the paradox. Total financial debt, excluding lease liabilities, increased by 9%, rising to 422.3 million TL.
But the debt-to-assets ratio is still low.
It is because of that high equity base. The total debt to total assets ratio increased only marginally, from 0.24 to 0.25. So the overall debt levels are managed, but the composition of that debt is the problem.
And that composition is overwhelmingly denominated in foreign currency, primarily US dollars, exposing them to massive currency risk. What are the precise figures on their FX position?
The negative net foreign currency exposure is alarming. Total foreign currency liabilities amount to 269.9 million TL, consisting almost entirely of USD-denominated bank loans.
Yeah, and their foreign currency assets.
They are minuscule. They stand at only 300.6 thousand TL. The balance sheet confirms specific USD loan principals, 4.6 million USD long-term and 2.8 million USD short-term as of September 30, 2025.
That is an immense short position in the lira. If the lira depreciates by, say, 10% in a month, their debt service obligations in TL terms just spike instantly. And we saw the result of this volatility hitting the financing expenses, which totaled 115 million TL, driven largely by FX losses on the debt and high interest rates. So how are they surviving this extreme exposure? They must have a defense mechanism beyond just relying on UCAM revenue.
They absolutely do, and this is perhaps the single most sophisticated financial disclosure in the entire report. Their hedging strategy under TFRS 9, this is their financial firewall.
Tell us about the hedging. The cash flow hedge accounting is what keeps their financial volatility from utterly destroying their income statement in the short term, right? It lets the business operate without these constant reporting shocks.
That's exactly what it's for. This is a complex but necessary application of International Financial Reporting Standard 9. Zedur utilizes a cash flow hedge to protect against the USD risk associated with their debt.
And how do they do that?
They achieve this by strategically matching the highly probable cash flows from their future USD-linked sales, specifically from UCDEM, against their USD debt obligations. The anticipated USD revenue stream acts as the hedging instrument for the inevitable USD debt payments.
I understand the goal, but what was the actual result of this strategy during the period of extreme volatility?
The strategy led to a substantial foreign currency loss, specifically 49.2 million TL being effectively parked directly in equity.
So it doesn't hit the P&L.
It does not hit the profit and loss statement immediately. It's deferred until the underlying hedged transaction, the guaranteed USD-linked sale, actually occurs and the cash flow is received.
That's a huge operational and a reporting advantage. It stabilizes the P&L from immediate, non-cash FX losses, preventing massive erratic swings that would otherwise confuse investors and likely violate loan covenants. This is management using sophisticated tools to survive the macro environment.
It is a critical risk mitigation technique, and the report confirms its success. They calculated the hedge effectiveness ratio at 103%.
Which is very effective.
Very. According to TFRS 9 rules, an effectiveness ratio between 80 and 125% confirms the strategy is working as intended. A 103% effectiveness means the hedge is almost perfectly neutralizing the risk, which is an extremely positive disclosure regarding their financial risk management competence.
So they aren't just exposed, they are actively and effectively managing the exposure.
They are.
So, while the underlying operational business is struggling, the sophisticated accounting maneuvers, TMS 29 for inflationary gain, and the TFRS 9 cash flow hedge for FX loss deferral are keeping the reported financial position and income statement stable. But let's check the actual fuel cash flow performance. Are they generating real cash?
Cash flow. This reveals a clear divergence between operational strength and debt reliance. Operating cash flow before changes in working capital was 45.5 million TL, showing relative stability year over year.
Okay, that's not bad.
No, it suggests the gross cash margin on activities is somewhat stable. However, the net cash flow from operations was significantly lower at 23.6 million TL compared to 67 million TL in the prior period.
That is nearly the 65% drop in net operating cash flow. We identified the primary culprit earlier, didn't we? The receivables.
We did. That massive drop was primarily due to the large increase in working capital items, particularly that surge in trade receivables. The change in receivables was a drain of 28.1 million TL on cash. When customers take longer to pay, even profitable activities don't translate into immediate cash.
So the business is becoming much less efficient at converting sales into immediate liquidity.
Much less efficient.
So if net cash from operations is so low, how did their cash and cash equivalents almost double on the balance sheet?
That leads us directly to financing activities. Net cash flow from financing was essentially flat, but this is misleading. It masks crucial movements under the hood.
What's going on there?
The company took out large new borrowings totaling 166.2 million TL. That's almost double the 87.4 million they borrowed in the previous year. Simultaneously, they paid out extremely high interest payments, totaling 68.6 million TL in just these 9 months.
So the synthesis here is unavoidable.
It is. The increase in cash, which was positive on the balance sheet, was heavily debt-funded, not generated organically by core operations. They are relying on external financing to support the business and manage the negative cash flow conversion caused by slow-paying customers, all while the cost of that financing is skyrocketing.
Finally, let's quickly skim the footnotes and critical disclosures. This is where we catch the detailed signals that inform the overall risk picture. First, the crucial question of solvency and business continuity.
The company affirms it is operating under the principle of going concern, and it explicitly states its capital is not considered impaired under the Turkish Commercial Code. This is standard, but it's an important assurance. Management believes the business will continue operating for the foreseeable future.
And we must reiterate the profound inflation accounting impact one last time.
Yes. For you, the retail investor, you have to grasp that the pervasive use of TMS 29 means the financial results are synthetic. That massive monetary gain that saved the pre-tax profit is an accounting artifact. The entire comparison base is fundamentally altered by the corrective factor applied to non-monetary items.
So you can't compare these figures directly to non-inflation adjusted results from international peers.
Not without deep professional adjustments. It's apples and oranges.
What about their commitments and pledged assets? How leveraged are their physical assets against this rising debt load?
They hold significant guarantees and collateral totaling 3.39 billion TL.
That's massive.
It is. And it's predominantly in the form of mortgages, about 2.89 billion TL, related to their own operational assets. This indicates substantial assets are pledged against their financing arrangements, which is a necessary requirement to secure that large USD-denominated debt.
A risk factor. The lenders have high security over the company's property.
Yes, it is.
And any red flags regarding related party transactions, which are often a concern in closely held companies like this, given that 5-to-1 voting power disparity.
Encouragingly, the report notes the elimination of previous related party transactions related to subsidiaries. The only external related party transactions disclosed are the full reversal or clearing of Necdet Rekaydurson's short-term accounts receivable and accounts payable.
So they cleaned up the books.
This indicates that outstanding related party balances were settled during the period, which is a positive sign for corporate hygiene and governance. It shows management is actively cleaning up those internal financial relationships.
And finally, a clean sheet on legal issues.
Confirmed. The report explicitly states there's a lack of ongoing material litigation or administrative or judicial sanctions that could materially affect the company's financial status. In a highly regulated sector like energy and infrastructure, that's an important positive signal.
That was an intensive deep dive, navigating the core operations, the high-stakes financial engineering, and the complex accounting maneuvers within Zedur AG's Q3 2025 reports. Let's bring it all back to the most important takeaways for you, the retail investor.
The core message for Zedur is one of powerful strategic vision colliding with immediate operational weakness.
A great way to put it.
The company is strategically focused on a high-growth, high-potential sector renewable energy, specifically that DGES expansion, with projects like UNECT promising a staggering 135% capacity increase. This is the future value proposition.
But the immediate reality is that the core business performance is flagging badly.
Exactly. Its current operational performance is poor, marked by a significant 32% decline in revenue and a 67.5% collapse in gross profit. That led to an operating loss in 9M 2025.
And financially, they're walking a tightrope.
They are. They're highly exposed to FX risk due to that huge USD debt. But they manage this volatility expertly through a highly effective TFRS 9 cash flow hedge. And critically, their survival in terms of reported profit is currently reliant on non-cash monetary gains generated purely by inflation accounting.
So essentially, the accounting framework and sophisticated hedging are currently insulating them from the full, devastating consequences of the macro environment and their weak operational core. It's buying them time.
Precious time. Time to execute the DGES strategy.
The question for the investor, then, is whether the operational weakness can be solved and if that strategic pivot will deliver new, high-margin, cash-generating revenue before the financial costs of hyperinflation and high debt become unmanageable.
That's the billion-lira question.
If you found this discussion helpful in navigating the complexities of high-inflation financial reporting and Zedur's strategic pivot, please make sure you hit that like button, subscribe to the Deep Dive channel, and share this content with others who need this clarity.
And here's a final thought for reflection as you consider Zedur's future. This deep dive shows us that when a company operates under hyperinflation, the reported net profit is often an accounting function of debt positioning, not a genuine reflection of sustainable operational success. So given the projected 135% capacity increase from the new DGES project, how long can Zedur rely on non-cash monetary gains to stabilize its bottom line before operational revenue from those new high-value storage assets needs to catch up and actually generate sustainable, real cash profit? It's a race between clever accounting stability and large-scale project execution.